Welcome to our investment seminar on what is a 401k. My name is Doug Heyman, president of Expert Software Systems and creator of the Retirement Calculator at www.calculatingretirement.com. Okay, let's get started. First, a quick introduction on 401ks. A 401k is a deferred compensation retirement vehicle that was first introduced and ratified by Congress in 1978 as part of the Revenue Act of 1978. Hence, it's only been around for under 40 years. There are many advantages to having a 401k. Number one, it allows you to save money for retirement. Number two, it provides a tax shelter, lowering your taxable income. For example, if you're making $50,000 a year and you contribute $5,000 to a 401k, that $5,000 comes off the top of your gross and you effectively only pay tax on $45,000 in that example. Number three, if your company provides a sponsored 401k program, they may, as part of the program, offer you matching contributions. For example, they may say, if you contribute 5% to your 401k, we'll match that with a 3% match. If the company is doing that and matching contributions, it is effectively free money, and you must jump all over that. Number four, any tax that's paid on withdrawal of your 401k after retirement will be taxed at a lower rate, presumably. Presumably, you'll be in a lower tax bracket once you retire than during your working years. And finally, number five, any contributions, matching contributions by your company and earnings will grow tax-free until retirement withdrawal. You need to plan for retirement at your earliest age possible. As soon as you start working, you should be putting money into a 401k. 401k is the de facto retirement standard for Americans today, in that defined pension plans or guaranteed monthly stipends on pensions are ceasing to exist in the industry. There are estimates that only 1 in 8 employees nationwide have defined pension plans, and those numbers are going down year over year. So what are the current 401k investing maximums? The IRS currently allows for $18,000 per year per person to be contributed to a 401k plan. If you're age 50 or older, that annual maximum increases from $18,000 to $24,000. The IRS kind of gives you a bonus for being older and allows you to contribute or catch up with your 401k contributions in that case. Additionally, if you're self-employed and have a solo 401k or SEP, Simplified Employee Pension, that annual maximum is actually 25% of your total income, which can be substantially more than the $18,000 or $24,000 that I mentioned earlier. So how do you get a 401k? More and more companies today are offering their employees 401k programs in lieu of defined pension plans, and that list is growing all the time. Company-sponsored 401ks are very often accompanied by matching contributions or free money, as I stated on an earlier slide, with an associated vesting schedule. Now, companies will let you contribute most of the time up to the IRS maximum, which I mentioned in an earlier slide. But additionally, they will offer you free money or matching contributions based on a threshold of contribution on your part. For example, a company might say that if you contribute 5% to your 401k during the course of a year, they will match that 5% with 3% of their own matching funds. That 3% will usually carry a vesting schedule associated with it. You might not be able to take that money with you unless you've worked for the company for maybe 5 or 10 years, or it might be a graduated vesting schedule where you're vested, say, 20% of that matching funds each of 5 years. Really, these plans vary from company to company, but the object is to take advantage of the free money or the matching contributions whenever you get a chance. Company-sponsored 401ks typically have a defined set of investment vehicles that allow you to allocate your funds of your 401k contributions. This varies widely from company to company, and typically companies will have 10 or 15 different funds that you can invest your money in, ranging from stock funds to bond funds to cash funds, international funds, you name it, and they exist. For self-employed people, you can establish a solo 401k or an SEP, Simplified Employee Pension, where limits of investing are greater than the company-sponsored limits, as I had mentioned earlier. But not only that, with a 401k or solo 401k or SEP, you can actually use any brokerage house to invest your money. For example, I use a brokerage called TD Ameritrade, and I'm not endorsing the use of them whatsoever. I'm just citing them as an example. TD Ameritrade allows me to invest my funds in anything under the sun. It could be ETFs, it could be mutual funds, it could be foreign exchange funds. I can even put my money in shorting funds. It gives you a lot more flexibility typically to invest a solo 401k in one of these programs than a company-sponsored plan will give you. But anyway, that's basically how you get a 401k and what you need to do to maintain it. One of the main pluses of 401ks is the tax advantage that it offers. In an example, let's assume you're making $70,000 per year and you're in the 25% tax bracket. If you didn't invest in your company's 401k, you would pay 25% in taxes, or $17,500 during the course of a year. This means that a $70,000 salary would net you $52,500 in take-home pay. Alternatively, let's assume you're contributing 10% of your salary to your company 401k. Hence, $7,000 would be contributed to your 401k during the course of a year, but you would now only be taxed on $63,000 as opposed to the $70,000, since your 401k contribution is tax deferred. That $7,000 gets lopped off your gross, and now your new taxable base becomes $63,000. So in the contribution case, your total income tax paid would be 25% of $63,000, or $15,750, which would effectively reduce your tax rate to 22.5% from the 25% had you not contributed. So by contributing $7,000 to your 401k, you would wind up paying $1,750 less in taxes during the year, and you would have $7,000 stashed in your 401k, also earning interest based on the investments you allocate your funds to. Later on, when you retire, and let's assume you're only going to be in the 10% tax bracket, because presumably you're in a much lower tax bracket when you retire, that raw $7,000 would only require you to pay $700 in taxes, as opposed to the $1,750, or the 25% of $7,000 mentioned above. This is not taking into account any sort of earnings that you're going to be gaining on your 401k, any matching funds, and things of that nature. This is just raw tax benefits. This is a tabular representation of the example on the last slide, where you have a salary of $70,000. In one case, you're contributing $7,000 to 401. In the other case, you're not contributing. If you notice that the taxable income of the $70,000 salary with a 10% contribution now becomes $63,000, and the taxes at 25% are hence reduced, so you're only paying $15,750 when you contribute 10% of your 401k, whereas you're paying $17,500 if you're not contributing. Your net income would obviously be higher without contributing. You have $52,500 versus $47,250, but your effective tax rate is lower, 22.5% to 25%, and you have to remember that you're putting $7,000 into your 401k account. So in the column where you're contributing, your net income of $47,250 plus your $7,000 in your 401k gives you a total net of $54,250 when you contribute. When you're not contributing to your 401k, you have $52,500 as your net, zero obviously in your 401k plan, and your total net is $52,500. So this clearly delineates how contributing to a 401k plan and taking advantage of tax advantages is clearly the better choice. Not to be redundant, but when it comes to investing your 401k contributions, matching funds, earnings, things of that nature, company sponsored plans usually provide a fixed or limited set of investment vehicles to invest your contributions, matchings, and earnings. Typically, you'll be allowed to put your money into stock funds of varying risk, bond funds, cash funds, things of that nature, and typically a company will offer maybe 10 to 15 different funds that you can allocate your contributions, matching, and earnings to. When you're self-employed and have a solo 401k or simplified employee pension, you can put your funds with any brokerage and really avail yourself of any funds or any instruments that you want to invest into. I use TD Ameritrade for my solo 401k. I'm not advocating the use of them, just citing it as an example. And I have my funds allocated in individual stocks, bonds, CDs, commodities, oil, short funds. I really, I can put my money into anything I want. So the solo 401s or SEPs provide you with a lot more latitude in terms of where you can invest your money. What are the rules regarding withdrawing 401k money for retirement? Well, the IRS has stipulated that you can withdraw money for retirement from a 401k plan beginning at age 59 and a half. When you withdraw, and you're withdrawing money from contributions you've made, matches that your company may have made, earnings that have accrued from the funds that you've allocated your 401k contributions to, they will all be taxed at presumably a lower tax rate, since you'll be earning less during retirement than you did during your working years. So if you were in the 25% tax bracket when you were working, and you're in the 10% tax bracket at retirement, that differential, or that 15%, is a significant tax savings that you have accomplished by saving money into your 401k plan over the years. One other rule is there's a thing called the RMD, or the required minimum distribution, that the IRS has set, and you must begin to withdraw based on RMD rules by age 70 and a half. So in other words, you can't leave money in your 401k endlessly. You have to start withdrawing by age 70 and a half, and hence pay taxes on those withdrawals at that time. Can you withdraw your funds from your 401k prior to age 59 and a half? The short answer is yes. However, there are penalties involved. If you withdraw your money prior to age 59 and a half, any money that is withdrawn will require you to pay tax on that money, back taxes, on those contributions and earnings, plus a 10% penalty in addition. So the IRS wants its money back, the tax-deferred money that it's been giving you all these years, plus a 10% penalty on top of it. Exceptions to the 10% penalty rule, not the taxes, but just the penalty rule itself, exist, and in 3 separate cases that 10% penalty rule can be waived. Number 1, if you're using the money for a first-time home purchase. Number 2, if you use the money for education, college, I believe graduate school also is covered within that particular item. And number 3, hardship. For example, if you're without a job for a period of time, or you become disabled, or anything like that that causes hardship, then that's another case where you can withdraw funds, just pay the taxes on it, but not incur that 10% penalty. What are some of the comparable investment vehicles to 401k? Well, you've probably heard of traditional IRAs, individual retirement accounts. For those people who do not have company-sponsored 401k plans, people can invest in their own IRAs, and IRAs are very comparable to 401s in that the money put into them up to a defined limit, the current limits are $5,500 per individual, are tax exempt. In other words, provides you with not tax exempt, but tax deferred, I should say, in that it offers you the same tax advantages that a 401k does. Additionally, if you're putting in less than 18,000 or 24,000, if you're over age 50 into your 401k plan, that differential can be allocated to an IRA. But between your 401ks and your IRAs, you can't exceed the $18,000 and $24,000 thresholds that I'd mentioned earlier in this presentation. Additionally, there's things called Roth IRAs. Roth IRAs are money that's already been taxed that you put into a IRA, individual retirement account, but the earnings on withdrawal from the Roth IRAs are not taxed. So the earnings accrue tax-free. That's a significant difference between 401ks and traditional IRAs where the earnings are taxed on withdrawal. We've mentioned solo 401ks and simplified employee pension plans for self-employed individuals or companies that allows you to put up to 25% of your earnings into these funds. They act similarly to 401ks and traditional IRAs on withdrawal. 403Bs are comparable to 401ks and are typically given to public school employees and tax-exempt organizations. 457s are another form of 401k for government employees where the only difference is that no 10% penalty for early withdrawal is required on any kind of funds that are withdrawn early. Since Roth IRAs are a relatively new investment vehicle, they came well after 401ks were born, there's been a raging debate in the industry over whether 401ks should be liquidated and converted to Roths, given that Roths earn interest tax-free forever on withdrawal. You never have to pay tax on the earnings of a Roth IRA. There are people in the industry like Susie Orman on CNBC who encourages doing that. I am someone who discourages it. I believe a 401k is a much better vehicle overall, tax-wise, savings-wise than a Roth is. What you would do is if you did convert your 401k to a Roth, is you'd have to withdraw your money from your 401k. You would have to pay tax on that money, and that tax burden can be rather significant. The IRS permits you to bypass the penalty when you're converting your 401 over to your Roth. But still, if you have $100,000 in your 401 and you're in a 25% tax bracket, you'd have a tax bill of $25,000, and then that remaining $75,000 could then be invested in the Roth tax-free for its duration. Again, I'm not someone who's a proponent of that. It is a good idea to consider it if tax rates are projected to go much, much higher. It's a bad idea if tax rates remain low as they do today. So that's my conjecture. I believe that in a low tax environment, 401k is a much better vehicle for savings. The tax liability on a 401k liquidation can be prohibitive, as I mentioned earlier, and the Roth IRA interest-free accruing over time is really the only redeeming factor that I see. This concludes our 401k investment seminar. I hope you've enjoyed it, and I'd like to offer you some additional information. which can act supplementary to this seminar. First of all, we offer a free When Can I Afford to Retire ebook that's on my website at www.calculatingretirement.com. Additionally, on that site, we offer a Windows Excel-based retirement calculator that's offered for sale to track income, expenses, assets, Social Security, pensions, 401ks, etc., and provides a solid vehicle to plan for retirement. Additionally, we offer one-on-one financial consulting available on our expert software site, www.expss.com/consulting/financial-consulting.htm. And we also offer a budget book for sale that many of you may be interested in at our site of www.budgetsurgeon.com. Again, thank you for attending and listening to our investment seminar, and we hope to see you again.